which is sometimes referred to as the balance sheet equation. The equation itself states assets equal liabilities plus owner's capital. And sometimes you'll see owner's capital designated as owner's equity. When we use the accounting equation, we usually do not write out the words assets, liabilities, and owner's capital. We normally use the capital A to designate assets, and we say this is equal to capital L, which designates liabilities, plus capital C, which designates owner's capital. Now, assets are the resources the firm uses to generate revenue. Sometimes the use of the word resources gives students trouble. So I want you to think of resources as the things the firm owns, such as its cash, its accounts receivables, its inventory, its equipment, its trucks, its copyrights, trademarks, etc., which it uses to generate revenue. Assets can be tangible or intangible. A tangible asset is an asset that has a form, a shape, and you can feel it. For example, inventory, equipment, furniture, truck. Those are assets you can feel. On the other hand, there are intangible assets which do not have a form or shape, and you cannot touch them or feel them. Examples of these are patents, copyrights, and trademarks. A patent is simply a right granted to an inventor by the government for a certain period of time during which the inventor can produce and sell his invention without being infringed on by others. Similarly, a copyright is a right given to the originator of a literary work, such as a song, a painting, a novel, that enables the originator to produce his literary work and sell it, again, without being infringed upon by others. And a trademark is simply a word or a group of words or a symbol that is registered and allowed to be used as representing the company. An example of this would be the McDonald's arch. If you're driving on a highway and you're hungry and you see this golden arch, you know that's a McDonald's and you can stop there and eat. Another example is that swoosh sign that looks like a check mark, which represents Nike. These are examples of trademarks. Liabilities, on the other hand, are the monies the firm owes its vendors, suppliers, employees, government, etc. These are monies the firm has to pay. Owner's capital is the monies the company owes the owner if the company were to sell all of its assets and pay off all of its liabilities. In other words, it's the book value of the company, a term that we'll talk much more about in future videos. Now, let's take a look at the accounting equation one more time. The accounting equation is assets equal liability plus owner's equity. Whenever you analyze any kind of a transaction in accounting, the transaction is going to affect the accounting equation. However it affects it, both sides of the accounting equation must always remain in balance. If they are not in balance, then there's something wrong. Now let's go over several examples to show you what I mean by the accounting equation must always stay in balance. I've made up some numbers here. Assets of $1,000 equals liabilities of $700 and owner's capital of $300, so that you got the equation balanced on both sides, 1,000 on the left side, 1,000 on the right side. Now, let's say we have a transaction where a company buys an asset for $100 and pays for that asset in full. How does this affect the accounting equation? Well, Let's rewrite this information down below. Assets equal liability plus owner's capital. We know that the original equation had $1,000 on the left side and 700 plus 300 on the right side, so it's in balance. Now, if the company goes out and buys a $100 asset, then the total of the assets is increased by $100. Whether the company paid for it or not. In this case, the company paid the full price, the full $100. So another asset, cash, is going to go down by that same amount of money. So we have another asset here. It's going down by $100. So now, if we total up the result, we see that 1,000 plus 100 minus 100 is still equal to 1,000. And there was no change on the right side of the equation, so that's just the 700 and the 300. And as you can see, the equation still remains in balance. In fact, in this case, only one side of the equation was affected. That is, one type of asset was converted for another type of asset. Let's look at another example. We'll call it example 2. A company buys a $100 asset on account. Okay? What this means is that the company purchased a $100 asset and it did not pay for it. That's what on account means. So the company owes $100. Well, how does this transaction affect the accounting equation, and do we still remain in balance? Let's rewrite some of these things down here so we can see it clearly. The original equation was $1,000 in assets equals $700 in liabilities plus $300 in owner's capital. Now, we purchased a $100 asset, which means our assets are going to go up by $100. Since we did not pay for it, cash is not going to be affected. However, we owe $100 to a supplier or a vendor, which means that our liabilities are going to increase by $100. And now, when you look at the total effect of this particular transaction on the accounting equation, you got $1,100 equals, $1,100 in assets equals $800 in liabilities because of the additional liability, plus the same old $300 in owner's capital. And as you can see, $1,100 of assets on the left side equals the 800 and the 300 in liability and owner's capital on the right side. Let's look at one more example, which contains a little bit of both of each of these two examples. In example number 3, a company buys a $100 asset and pays $25 down. Alright, what does this mean? It means that the company purchased an asset for $100 and it only paid $25 towards that $100. So the company owes a vendor or a supplier $75, the difference between the two. Now, how will that affect the accounting equation? Well, we'll bring things down again one more time. And the original equation was $1,000 equals 700 in liabilities plus 300 in owner's capital. Now let's see how this works. The company purchased an asset for $100, which means these assets are going to go up by $100. However, the company made a down payment of $25, which means the asset cash is going to go down by $25. And we also know that because of this, the company now owes an additional